My name's Alden Donnelly. I'm a consultant and past president of a private sector consortium called GEMCO. And at one time, we were the largest private sector speculative buyers of carbon credits in the world. My question is to both the banking and insurance community. My experience would suggest it is pretty easy to mobilize the required capital for green energy if we actually have introduced double entry bookkeeping into the carbon market, which neither the UN nor any mandatory market has done. So right now, every carbon credit traded in the world is an asset that purports to represent a reduction in an inventory, but nobody has to report an inventory and nobody books a balancing emission debit to a reported inventory when they sell real interest in a credit. I can't get my CEOs to invest in the next credit default market because because there's no double entry bookkeeping. But as soon as somebody says, I'm only going to buy credit, Citibank, from an entity that publishes an inventory and books a +1 ton for every -1 ton I buy from them, I can bring you a lot of private sector dough. So my question is, why are we building the next credit default swaps market unnecessarily, easy to fix, up to you guys? When are you going to do it?
That is the best double entry bookkeeping question I've ever heard. Alden, the brilliant question, the way I'd interpret it in my simple mind is this, that you're basically saying our accounting system for carbon is broken, is bent, has never been fixed, has not been, I'm not going to let you speak. I'm just going to, if you disagree with me, say, no, you got it wrong. So you're saying the system's not right yet. And you're actually saying that what we're doing is we're setting up, yeah, okay, we've had the credit crunch and we've had the system which generated that. You're setting the carbon crunch up. That's what you're saying. So you're saying the way we account for carbon in the evolving nascent system is wrong and it needs fixing. Is that what you're saying essentially? And it's easy to fix. Okay. Does anyone want to have a pot at that? Sandra, top points.
Well, I'm not an accountant, so I'm not going to dig in too deeply, but one of the things that occurs to me, and I think you also suggested that double entry bookkeeping of CO2 would help drive clean energy investment. And that's interesting, and it's something that I'm definitely going to look into when I get back because I'd like to understand it better. But I would say that, frankly, until CO2 has regulatory clarity, so until we know what the rules are, and then we can establish the accounting standards based on those rules, in most of the jurisdictions in which we do business, we don't look at carbon. It isn't appearing on the balance sheet because it doesn't have a known value. So I'm not sure that that is sort of a sideways answer to your question, or maybe a corollary to it, but certainly right now there's no rules, and so there's no accounting standards, and so we can't actually include it in the analysis.
So, PEJ News. I want to address the issue of due diligence. Now, I don't know if this is still the case, but I remember at Globe some time ago, there was a session on socially responsible investment, and someone who was handling the investments, the group investments from a university, said that she had trouble investing in socially responsible investments because if they failed, she would be considered not to have exercised due diligence. However, if she invested in the Fortune 500 and if they lost, then she would not be accused of not exercising due diligence. And I think maybe if we want to go towards a low carbon economy, maybe in the list of due diligence would be that if someone responsible for investment does put investments into corporations that are producing carbon emissions, then that should be an indication of lack of due diligence.
When you manage money for other people, you have a responsibility to be a good fiduciary. There's fiduciary duty, which means you have to manage those assets in the best interests of your clients or your plan members. 10 years ago, maybe even 5 years ago, that meant that you likely couldn't look at environmental and social issues as part of the equation because there was a risk that if you looked at those issues, as you've said, and you lost money, your plan members, your clients could take you to court and argue that you weren't acting in their best interest. You were putting other things into the equation that shouldn't have been there. one of the great, I think, shifts in thinking that's happened over the last 5 or 6 years in the investment community is that that idea is flipped on its head. And today, there's a great deal of thought that says if you're not looking at environmental risk, social risk, and governance risk, then you're not fulfilling your fiduciary duty. I think of a company as an iceberg. And if we're only using our traditional financial tools, we're only getting part of the picture that sits above the surface. And I've always argued that looking at environmental, social risks and opportunities gives you a better equipped sonar. It gives you the information on the entire company. So it's just about making better investment decisions. And we've seen some great work out of the UN, UNEP-FI, I'm sorry. Paul Clements Hunt, under his able leadership, has looked at the fiduciary issue. And so we're seeing a real shift in thinking in that regard. But you know what's interesting is, may I just add, if we're just in this province in British Columbia, the law actually says for pension plans that those assets have to be managed in the best, quote, financial interests of plan members. It's the most stringent, one of the most stringent fiduciary regulations that you will find in the world. And yet, BCIMC says it is in the best financial interest and is looking at these things as part of that process across asset classes. So the world is changing.
Yeah, just a quick follow-up. Sort of following up on Sandra's comments about the diligence that we and others do, and linking it to efficiency, and to your point about looking at the broader picture. When we, in the U.S., when we look at coal-fired power generation and the financing of it, we have a shadow carbon price that we look at, but we also look at to what extent there are potential opportunities for someone else to come in and exploit efficiency opportunities in that particular service market. So there is, I think, a broader conversation that goes beyond risk, but that thinks about this a bit more, holistically and points to opportunities.
Where are we? We've got about 30 minutes left. We've got 4 questions up there, okay? But one of the issues with these sessions around finance and capital markets, you've got bankers, you've got insurance, you've got capital market people. It's not one sector. This stuff is complicated, right? So I think collectively as a room, you're getting a lot of valuable inputs and insights, and the conversation is good. But where are we in the journey? Go back to the golf ball. Sandra put it on the tee. Barbara sort of asked the question, which club are we using? Bruce was actually looking at all the different obstacles and the bunker and the way through and the hole in the roof, and like, all right, I'm pushing this, but you know what I mean. And Michael was in Michael was in the bar sipping a cocktail. So, but where are we in the journey? I mean, is anyone completely lost? Are people getting value in terms of how we move along the low carbon pathway? My point is that to understand finance, capital markets, investment in this context, you really need to invest time and put it together, your own model. Because these are complicated pieces, right? Okay? There's no question. This is a really myriad, complex system. You've got to think of the investment chain, from pension funds through asset managers, through financial analysts, through the companies you invest in. You think of all the intermediaries who play around that chain. This is complicated stuff. So I think a little bit of the homework post this session is, if you are serious about a low carbon pathway and you want to get there, invest some time in understanding this stuff. 85% of the capital and finance to get us there will come from private sources. And the capital markets and financial intermediaries have to be a big part of that.